Whole life insurance, cash value life insurance, is the payday lender of the middle class. I've been screwing the middle class for decades. No one sells whole life insurance except insurance people.
Finance expert Dave Ramsey dropped a bombshell. Whole life insurance is a scam. Dave Ramsey is one of those who got this point of view. In 2012, New York bestselling author Ramit Sethi called whole life insurance a scam. If you've signed up already and you've been paying premiums, you'd probably be forgiven for being concerned. It's like discovering that the vaccine you took a couple of years ago against a disease wasn't working as it should. And if you're not yet paying for life insurance, you may pay attention because there's a lot to learn from Dave Ramsey. Join me as I take you through why Dave opposes whole life insurance. Point number 1. Whole life insurance is expensive.
So it's 20 times more expensive, I'm sorry. So about $100 a month buys you the same amount of whole life insurance that $5 a month buys you in term insurance.
Dave claims that whole life insurance is about 20 times more expensive than term life for the same amount of insurance. As an analogy, you'll be paying $100 for whole life insurance, the same amount you can get with $5 for a term life insurance policy. That's a whole world of difference. CBS News business analyst Jill Schlesinger also corroborates Dave's claim in this clip.
Permanent life insurance like whole life or universal life, that's a more expensive option than term because the death benefit remains in place for your entire life.
According to Policy Genius, the average cost of a whole life insurance policy with a $500,000 payout for a healthy 30-year-old male is $440 per month. The same healthy 30-year-old male may not pay more than $30 for the same $500,000 payout for a 20-year life insurance policy. So, with a term life insurance policy, you'll pay a premium 93% less than what you'll pay for a whole life insurance policy. Also, compare whole life insurance with other life insurance policies like group life, variable life, and universal life insurance. You'll find out that they're still not as expensive as whole life insurance by a long shot, with premiums ranging from $20 to $200 for the same amount of insurance. You'd also find out that other alternatives to life insurance are also cheaper. Packages like income protection, critical illness coverage, mortgage protection, and life insurance from an employer offer some form of financial protection from the effects of different circumstances. And they're also cheaper than whole insurance. So why is whole life insurance so much more expensive? The much touted cash value, which I'm going to talk about next. Point number 2. Cash value isn't commensurate with investment.
What does the other $95 go to, since you're being charged $100 instead of $5 for the same amount of insurance? It goes to build up a cash value inside the policy, which for the first 3 years is 0.
Where does the difference go if a whole life insurance policy costs more for the same amount as a term life? The difference is used to build a cash value inside the policy. If you're consistent with your payments, the cash value can grow over the years and yield interest and policy dividends. How does cash value build up? First, know that the premium you pay is split in 3 ways: one to the death benefit, another to the insurer to cover costs and profits, and the third to the policy's cash value. Here's what the insurance company does with your money. They invest it in a conservative yield investment, more like a low-risk investment that focuses on preserving capital rather than making huge gains. As you continue paying premiums, cash value accrues interest and grows over time. As a policyholder, you can take loans and withdraw based on your cash value. This sounds appealing and should probably justify the high premiums, right? Well, not according to Dave. He draws our attention to the fact that the cash value doesn't grow for the first 3 years. That's shocking, and here's why. Commission on savings is 100% for the first 3 years in the guise of front-loaded commissions, which is 100% in this case. So even with high premiums, you make nothing in 3 years. That's a total rip-off. It appears that the only people who benefit from whole life insurance policies are the agents who get commissions and the companies that sell them. Dave argues that consumers don't get enough value for their money, regardless of how appealing they make it seem. So when you look at it again, alternatives like term life, variable life, universal life, and group life insurance policies, even without a cash value, appear to offer more value for money than whole life insurance. When you compare the cost of whole life insurance with the other types of life insurance, you can work out the difference. Then check whether the benefits that come with cash value outweigh or are at least equal to the difference in premium payments over the years. You'd find out that the cash value, the cornerstone of whole life insurance, isn't a big deal as the insurance companies say. It's an over-promoted concept with more value in marketing than in actual returns for the consumer. However you look at it, insurance is an investment for the future. Accordingly, there should be a rate of return that's at least commensurate with your investment. Point number 3. Rate of return is horrible for long-term investing.
And so it's a horrible rate of return for long-term investing. Absolutely horrendous rate of return on long-term investing.
Dave is so opposed to whole life insurance because of the rate of return, which he calls horrible for long-term investing. Before we move on, let's understand the terms. Many people think the dividend rate is the same as the rate of return. This isn't true.
Is because anytime we see a dividend interest rate, we always want to remember that that is a gross rate that is applied to your policy after the insurance company assesses their insurance expenses, mortality charges, and everything that comes with the actual life insurance policy. What we want to look for is the net internal rate of return. What is the cash value actually growing by?
Consider the dividend rate as the gross amount of the earnings of your insurance policy. The internal rate of return is the balance after the insurance company has removed all the expenses associated with the insurance policy. Now, according to Dave Ramsey, whole life insurance offers a horrible rate of return for long-term investing. He's correct because an analysis of the returns on investment for a whole life policy for a 30-year-old whose life expectancy was 53 years showed that guaranteed ROI on the cash value was not up to 2% after 50 years. Shocking. But why is this so even with wildly high premiums? The truth is that the premium is like a national cake where all the parties have a share. The salesman and the company will also have some money for commissions, expenses, and overhead respectively. Another percentage will be used to purchase the insurance. The remaining part goes into the cash value component of the policy. Here's where it worsens. You can only earn a dividend on the cash value, not the total premium paid. Remember that the cash value has zero yield for at least 3 years. For some companies, it may take up to 5 years. When it ever does, the yield will be too small to be meaningful. Now, you may surrender your whole life insurance policy. That is, cancel the policy. What would you get? You'll receive the cash value as of the time and the amount paid in premium. Imagine you cancel the policy within the first 3 years of your policy and you'll get no returns. What kind of investment is that? So while the idea of investment is to earn a return proportional to your investment, with whole life insurance, you earn dividends that are lower than your investment. I'm talking about negative returns, like losing money on an investment. This is why Dave Ramsey considers whole life insurance a bad investment choice, and I couldn't agree more. You'd rather be well off with a typical investment plan that can earn dividends, which can also be reinvested to acquire more shares of the same stock. You can get rich by buying stocks, but the odds are strongly against you if your path to this dream is a whole life insurance policy. Imagine putting all that money into buying stocks over a long time. According to Forbes, the average dividend yield on a whole life insurance policy is 4.65%. If you buy a stock with that amount, you'll have a better return of 7%, 12%. Your investment will even grow substantially from compounding interest. Now, get a term life insurance policy that gives you coverage for some time at a lesser cost than your whole life. You could put your money in other investments, yielding big returns, much more than you can get from a growing cash value. You'll still make more money even if you invest in a conservative yield investment. Take mutual or exchange-traded funds, for instance. These are two types of investment insurance companies that put your money to grow your cash value. According to NASDAQ, stock mutual funds of high-performing stocks have recorded returns of up to 17% in the last decade. Compare that with a cash value of less than 5% return within the same period. Also, consider the rate of return for exchange-traded funds. Some funds have posted a 52% rate of return after 5 years, and some have recorded returns of up to 15%. Although some have posted losses, a good investment would yield more money than you can get from cash value. Point number 4. Only the amount of insurance goes to the beneficiary after the insured dies.
And so it's a horrible rate of return for long-term investing. Absolutely horrendous rate of return on long-term investing.
So at the end of the day, when the insured person dies, the money goes to the beneficiary. Now you'd expect there will be some return on the cash value since it's been yielding interest and earning dividends over time. But this isn't what happens, according to Dave Ramsey. The beneficiaries receive only the amount of the insurance. The cash value is gone. This is the same cash value that makes whole life insurance different and seemingly more attractive than other types of life insurance. The same cash value justifies the high premium. So it's not out of place to say that only the company and the agents benefit from whole life insurance, because I don't see how this system benefits the consumer in any way. Your investments go with you, and this is a huge problem for investors. With regular investments, someone gets to inherit the share, but with whole life, the investment vanishes while the benefactor gets only the amount of insurance coverage. So, you'd be better off investing than paying lump sums for premiums when you get the same payoff with term life insurance. The cash value isn't worth it as advertised, so you can still diversify your income in other investments and earn a substantial profit. So while whole life insurance may offer some benefits, many advantages advertised by insurance agents and companies are at variance with reality, and therein lies the scam. There's nothing wrong with getting life insurance. People who acquire life insurance do so that their absence will not hurt their loved ones, at least economically. But then, you should get value for money like every product or service you buy. This is the thrust of the matter with whole life insurance. People like Dave Ramsey and Ramit Sethi argue that it doesn't offer value for money. Yes, it offers lifetime coverage, but you can do better elsewhere. Insurance agents and companies would do greater service to their customers by giving accurate information about the real value of their services, whole life insurance in this case. I hope you enjoyed this video. Do you have whole life insurance or any of the alternative options I've discussed? I'd like you to comment on your experiences, especially the challenges and the benefits you've enjoyed. And while you're at it, remember to like and share this video and subscribe to my channel. See you on the next one.